37% in a single session with no news, no announcements, nothing at all. That isn't a market crash. That is an execution. Silver was trading at $121 on Friday morning. Then it plummeted to $75. $46 of value evaporated in just 6 hours. Gold fell from $5,600 to $4,700. $900 vanished. And here's the critical detail. No new war began that day. No pandemic suddenly emerged. No major bank collapsed. There was nothing on the wires. No breaking news headlines. Total silence from every major media outlet. We just observed the most severe single-day collapse in precious metals in years. And no one appears capable of explaining why it occurred. But I can. And when I reveal what I discovered, you will comprehend why this continues to happen, why it occurred in 1980, why it occurred in 2011, and why it is destined to happen again. 3 instances across 50 years, identical pattern, identical tool, identical devastation. This is not a conspiracy theory. This is documented history, and you are about to witness it with clarity. Welcome to the Hidden Economy. If you are new to this channel, I uncover the true dynamics moving markets while everyone else is preoccupied with headlines. Subscribe immediately because this is the caliber of analysis you won't locate elsewhere. And if you derive value from this video, please smash that like button. It assists the algorithm in presenting this to more individuals who need to see it. Friday morning, January 30th, the final trading day of January, the last session of the week. Silver is positioned at 121. January had been silver's strongest month in decades, 65% gains in merely 30 days. The sentiment was universally bullish. Analysts were forecasting $200, even $300. People were declaring, "This is the greatest rally of our lifetime." Social media was in a state of euphoria. Everyone believed they had bought the dip at the perfect moment. Everyone was becoming wealthy. Then 9:30 a.m. arrives. New York opens. Within seconds, a tidal wave of sell orders inundates the market. And these were not retail traders booking modest profits. This was institutional in scale. Massive blocks, millions of ounces being dumped simultaneously. The kind of coordinated selling that simply does not occur by accident. Silver falls from 121 to 115, then to 110, then breaches below 100. That psychological barrier everyone claimed would hold permanently. The support that was supposed to be unbreakable, it was gone, shattered in mere minutes. But it didn't stop there. 95, 90, 85, 80. Stop-loss orders were triggering everywhere. Margin calls were flooding into brokerages across the nation. Traders were being liquidated whether they wished to sell or not. The system was selling on their behalf. By the close, silver stood at $75. Gold was at $4,700. 6 hours, 37%. Hundreds of billions in market capitalization simply erased. I observed it unfolding in real time. I watched fortunes disintegrate. I witnessed years of gains transform to dust within hours. And the question everyone is posing tonight is straightforward. What happened? What changed? The answer provided to you was nothing. Just a correction, they said. Markets became overextended. A healthy pullback. That is the official narrative. Here is what truly occurred. Examine the 60 days preceding Friday. Pay meticulous attention to the dates. December 12th, silver is surging and capturing headlines everywhere. The CME Group, the exchange governing silver futures trading, increases margin requirements by 10%. It scarcely makes the news. December 29th, silver continues its ascent, showing no signs of slowing. The CME raises margins once more, and this time it is aggressive. A 25% jump overnight without warning. December 30th, the very next day, less than 24 hours later, they raise margins again. 2 hikes in 2 days. That almost never occurs. January 28th, Just 3 days before the crash, they do it again. This time, they alter the entire system, shifting from fixed dollar amounts to percentage-based margins. 9% becomes 11%. For riskier accounts, it escalates to 12.1%. 4 margin hikes in 6 weeks, an 80% total increase. Now here is what that genuinely signifies for traders. Margin is the cash you must maintain in your account to hold a futures position. It is your collateral. When you purchase silver futures, you do not pay the full price up front. You post a fraction of it. That is how leverage functions. But when they raise margin requirements, every trader holding a position suddenly requires more cash. Not next week, not when convenient, immediately, today, right now. And if you cannot deposit that additional capital within hours, your position gets liquidated, sold. No negotiation, no appeal. You are simply out. Envision your landlord calling you right now and informing you your rent just increased 80%, and you have until tonight to pay, or you will be evicted. That is essentially the demand issued to every silver trader in America simultaneously. Your account needs 80% more cash. Deposit it within the next few hours, or we will sell you out. Most individuals do not have that kind of money readily available. They cannot pay. So they get liquidated, compelled to sell whether they desire to or not. And when thousands of leveraged traders are forced to sell at the exact same moment, what do you suppose happens to the price? It doesn't just decline, it collapses. It crashes 37% in a single day. This was not the market discovering fair value. This was not a bubble bursting naturally. This was not profit-taking. This was the CME pulling a trigger. And here is what should genuinely unsettle you. They have pulled this exact trigger before. 1980, silver ascends from $6 all the way to $50, an 800% gain in just a few months. Ordinary people are amassing fortunes. The system is under strain. What was the response? The CME creates something termed Silver Rule 7, which essentially prohibits leveraged buying overnight. You want silver? Fine, but you must pay 100% cash, no margin permitted. And that same month, the Federal Reserve Chairman raises interest rates from 11% to 20% in a single move. The result, silver crashes from $50 all the way down to $10. 80% destruction. It was over. 2011, silver climbs from $8 to $50, a 600% gain. Retail traders are piling in everywhere. Banks holding massive short positions are being absolutely crushed. What was the response? The CME raises margin requirements 5 times in 9 days. 5 times in just 9 days. That is an 84% increase. The result, silver crashes from 50 to 26, 50% obliterated in a matter of weeks. And it took 13 years for silver to recover from that crash. Now, here we are in 2026. Silver runs from $26 to $121, a 450% gain, the most powerful rally in modern history. What was the response? CME raises margins 4 times in 6 weeks. The result, silver crashes 37% in a single day, the swiftest destruction of the three. 1980, 2011, 2026. 3 times in 50 years. Identical setup, identical tool, identical destruction. Every single instance silver threatens to break out. Every single instance ordinary people begin accumulating genuine wealth in precious metals. Every single instance gold and silver start exposing the fragility of the paper system. The exact same playbook executes. This is not coincidence. This is not risk management. This is a pattern, a system. Something deployed whenever silver grows too powerful. Once is an accident, twice is a coincidence, 3 times is a pattern. So the question that truly matters is, why? Why does someone care this profoundly about crushing silver? The answer has nothing to do with silver itself. It has everything to do with what silver represents, what it threatens, what it exposes. This is about the dollar. The United States possesses one superpower that no other nation on earth holds, the world's reserve currency. Every country requires dollars to purchase oil, to trade internationally, to hold reserves in their central banks. This is why America can print trillions and still endure. This is why they can maintain 30 trillion in debt and continue spending, because the world has no alternative. Everyone needs dollars. Everyone must participate in the American financial system, whether they like it or not. But something is changing, and it is changing rapidly. Central banks globally purchased 800 tons of gold last year, not dollars, not treasury bonds, physical gold, actual metal they can hold in their vaults. In January alone, central banks sold 48 billion worth of U.S. treasuries, 48 billion in just 1 month. The dollar's share of global reserves has just dropped to 58%. That is the lowest level since 1995. 30 years of decline, and now it is accelerating. But here is the statistic that should genuinely terrify Washington. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Central banks worldwide now trust a metal more than they trust America's promise to pay. That is not a minor shift. That is the foundation cracking. And who is leading this shift? China, Russia, India, Brazil, South Africa, the BRICS nations. They are constructing payment systems that completely circumvent the dollar. They are settling trade in their own currencies. They are hoarding gold as if their survival depends on it, because it does. Now observe what else China is doing. China controls 60 to 70% of global silver refining. Not mining, refining. They are the gatekeeper. Silver gets mined in Peru, Mexico, and Australia, but it all gets processed in China. Without Chinese refineries, the entire global silver supply chain fractures. But silver is merely the beginning. China processes 90% of the world's rare earth elements, the materials in your phone, your laptop, your electric car, your missiles. 90% of it transits through China. They control 98% of gallium refining. Gallium is essential for semiconductors. They control 80% of cobalt processing. That goes into every lithium battery, every electric vehicle. They control 60% of lithium refining. The entire green energy revolution depends on lithium. The modern economy operates through Chinese processing facilities. Every piece of technology you use, every military system your country relies upon. And on January 1st of this year, China classified silver as a strategic national security resource. They imposed export controls on it, same category as military materials. Two superpowers with two entirely divergent visions for the future. China desires a world where physical resources matter, where metals possess real value, where the nation controlling the supply chains wields the power. They spent 30 years constructing precisely that position, and now they are utilizing it. America wants the opposite. America needs metals to remain cheap. They need gold to stay quiet. They need your wealth parked in dollars and treasury bonds and assets they can monitor and control. Because if silver reaches $500, what does that communicate about the dollar? If gold hits 10,000, what message does that transmit to the world? It declares the paper system has failed. It states 50 years of money printing has finally caught up. It proclaims the game is over. That message cannot be permitted to spread. So they crush silver. Identical method as 1980, identical method as 2011. Margin hikes, forced liquidation, price destruction. Meanwhile, China continues buying the physical metal. They keep draining the vaults, they keep accumulating while the West panics and sells. This is not market management. This is financial warfare between East and West. Paper versus metal, dollar versus commodities. And on Friday, you observed a battle in that war unfold in real time. The dollar itself narrates the same story. The dollar index had been declining for months, descending from 110 all the way down to 95.55, a 4-year low, the weakest dollar since 2022. And when the dollar falls, gold and silver rise. The reason is simple. Metals are priced in dollars globally. When the dollar weakens, it requires more dollars to purchase the same ounce of gold or silver. Plus, a falling dollar signals that people are losing faith in paper money. Consequently, they flee to hard assets. That is why dollar weakness has always been fuel for precious metals. But something critical occurred at 95. Precisely at that 4-year low, the dollar ceased falling. It discovered a bottom and began to reverse. It is now climbing back up, and metals crashed at that exact same moment. You believe that is a coincidence? The dollar finds its bottom, starts reversing, and silver loses 37% on the very same day. The margin hikes created the forced selling. The forced selling crashed the price, and the dollar reversal supplied everyone a convenient cover story. Oh look, metals were merely overbought. The dollar is recovering now. Everything is fine. This was coordination, the system defending itself on multiple fronts simultaneously. Now examine what is occurring in the physical silver market. Before Friday's crash, when silver was still trading at 121, mints worldwide were already struggling to meet demand. The Perth Mint in Australia had suspended wholesale orders because the backlog was too immense. They simply could not fulfill the demand. The U.S. Mint had halted Silver Eagle sales. Dealers were defaulting on deliveries. The price was at $121, and you still could not purchase physical silver easily. Now the price is $75. Attempt to buy an ounce today. Call your dealer. Check online retailers. Observe what premium they are charging over the spot price. See if they even possess any inventory. The paper price states $75, but the physical market is communicating a completely different story because paper silver and physical silver are not the same entity. Friday proved that beyond any doubt. Paper can be created with a keystroke. Paper can be crushed with margin hikes. Paper can be manipulated any time they choose. They control the exchanges. They control the rules. They control the entire game. But physical silver cannot be printed. It cannot be margin called. It exists in the real world, completely independent of their control. When you hold physical silver in your hand, nobody can margin call it away from you. Nobody can alter the rules overnight and force you to sell. It is yours. 2 markets, 2 prices, 2 realities that are diverging more profoundly every single day. While America was panic selling on Friday, and while traders were being liquidated left and right, while the paper price was crashing 37%, China was buying. Shanghai vaults drained 27 tons of silver in a single day last week, not sold on the market, removed from the vault. Physical delivery to buyers who desired the actual metal in their possession. This has been transpiring for months now. While Western investors trade paper contracts back and forth, Chinese buyers continue taking physical delivery. The vaults keep draining. The metal keeps moving east. America dumps paper contracts. China takes delivery of actual metal. America crashes the price. China says, "Thank you for the discount." One side is trading promises and IOUs on computer screens. The other side is loading trucks with actual bars of silver. Which side do you believe genuinely understands what silver is worth? Which side is playing the long game here? The fundamentals did not change on Friday, not one bit. Silver has been in a supply deficit for 5 consecutive years now. Every single year since 2021, More silver has been consumed than mined. The cumulative deficit exceeds 800 million ounces. That is nearly a full year of global mine production that simply does not exist. Industrial demand is exploding. Solar panels, electric vehicles, electronics, AI data centers, military systems, they all require silver, and that demand expands every single year. It is accelerating. Meanwhile, supply cannot keep pace. There have been no major new silver discoveries in years. Ore grades are declining at existing mines. It takes a decade to bring a new mine online, even if you discover silver today. Production costs continue rising. It is becoming more difficult and expensive to extract silver from the ground. Demand rising, supply constrained, deficit growing. None of that altered because of one crash. The deficit persists. The demand is still growing. The supply remains constrained. The fundamentals did not flinch. What changed on Friday is a paper price, a number on a screen, a number controlled by futures contracts and margin requirements. Paper prices can be manipulated. Physical supply and demand cannot. After the 1980 crash, silver eventually recovered. After 2011, silver eventually recovered. Both times it proceeded to make new highs. They can suppress prices. They possess the tools to accomplish it, but they cannot sustain it forever. Eventually, physical reality prevails. It always does. You simply cannot counterfeit supply and demand indefinitely. The question is timing, and nobody knows that answer. Not me, not anyone. Here is what I know for certain. The CME raised margins 4 times in 6 weeks, and silver crashed 37% in the final week of that sequence. This exact same pattern has played out twice before in the last 50 years. Both times, silver eventually recovered. China controls the majority of the world's silver refining, and they just implemented export controls on it. Meanwhile, America crashed the paper price. Central banks globally are selling U.S. treasuries and buying gold at the swiftest pace we have witnessed in decades. The physical market was already fractured before Friday. Now it is even more distressed. The gap between paper prices and physical availability is wider than I have ever observed. What I do not know is whether 75 is the bottom. Could silver decline to 50? Yes, it absolutely could. Could it rebound to 100 next month? That is also possible. Nobody knows for sure, and anyone asserting certainty right now is either deceiving you or attempting to sell you something. But here is what remains with me. If silver truly does not matter, why do they keep executing this? Why run the exact same playbook 3 times in 50 years? Why coordinate margin hikes immediately before crashes? Why does the CME care so profoundly about the price of a metal? They claim it is risk management. They claim it is for market stability. They claim they are protecting traders. But observe what happened on Friday. Traders were absolutely destroyed. Billions in losses, accounts completely wiped out. Years of gains vanished in hours. They are not protecting traders. They are protecting something else entirely. The dollar, the system, the narrative that paper money actually functions. The fact that they keep executing this. The fact that 3 times in 50 years they have crushed silver whenever it began to run. The fact that they simply cannot permit it to trade freely. That informs you precisely what silver threatens and precisely what they fear. In 1980, they told you they crushed silver to halt manipulation. In 2011, they told you they raised margins to ensure market stability. In 2026, they will tell you this was merely a healthy correction. Normal market behavior. Nothing to see here. But you can perceive the pattern now. The margin hikes, the coordination. 1980, 2011. Now China accumulating while America dumps. Central banks selecting gold over treasury bonds. You know what they do not want you to know? The paper price states silver is $75, but paper is merely a claim, a promise, an IOU that can be manipulated, margin hiked, or defaulted on at any moment. Metal is real. It exists in the physical world. It cannot be printed by a central bank. It cannot be hacked. It cannot be frozen by any government. It cannot be margin called out of your possession. They can crash the paper price. They cannot crash the metal itself. They can liquidate futures contracts. They cannot liquidate physical silver residing in your safe. They can manipulate markets, but they cannot manipulate reality forever. They keep printing trillions. Silver cannot be printed. One of those has to triumph in the end. And history has already voted on which one. Many voices will advise you to sell now. Cut your losses. Exit while you still can. And perhaps they are correct in the short term. Silver could definitely move lower from here. I genuinely do not know what happens next. But ask yourself this question. If silver were truly worthless, if gold were merely some outdated relic, if precious metals were genuinely irrelevant in the modern financial system, why would they need to execute all this? Why raise margins 4 times in 6 weeks? Why run the exact same playbook across 50 years? Why would China be stockpiling physical metal while America crashes the paper price? You do not combat this fiercely against something that does not matter. The intensity of the attack reveals the value of the target. Remember that when you are making your decisions. Friday was not a crash. It was a message, a reminder of who controls the paper markets, a demonstration of power. But it was also something else. It was confirmation. Confirmation that silver still matters, that precious metals still threaten the system, that after 50 years of fiat money and unlimited printing, they still have not determined how to render gold and silver irrelevant. And honestly, that might be the most bullish signal of all. They termed it a crash. I term it a crime scene. They termed it volatility. I term it the same playbook running for the 3rd time. They termed it risk management. I term it the system telling you precisely what it fears. 37% in a single day. No news, no explanation. Now you understand why. The margin hikes. The playbook from 80 and 2011. China versus America. Paper versus metal. A financial war that nobody discusses. The data is public. The dates are documented. The pattern is there for anyone willing to look. What you undertake with this information is entirely your decision. This is the hidden economy.